Kitco News special coverage of the New Orleans Investment Conference is brought to you by Discovery Group.
Hello, I'm Michelle Makori, and we are continuing our coverage of the New Orleans Investment Conference. And joining me now is fan favorite Adrian Day, CEO and Chairman of Adrian Day Asset Management. We always love catching up with you, Adrian.
Well, thank you, and thank you for having me back.
And I see you saying hi to the passers-by as we're chatting
well,
here.
That's Peter.
Peter Schiff, we were just talking about you.
See, don't forget to plug the fund.
And very few people realize that you, in fact, are not only the CEO and Chairman of Adrian Day Asset Management, but you also manage Peter Schiff's Euro Pacific Fund.
Correct. We've done this since it started in 2013.
Right, so you certainly know what you're talking about when it comes to gold, and we'll be catching up with Pete a little bit later, but let's focus on you now,
okay.
Adrian. And let's pick things up from where we left off last time, and we chatted in late January at another conference. And at the time we were discussing the Fed, of course, as we do. At the time it was the day before the Fed meeting of February. We were looking to hear what they would say. You correctly called that they would raise then. And you called that they would raise in January, you called that they would raise in February. And even though the sentiment at the time was that there would be a pause in March, you said the Fed is going to be aggressive and will raise in March. So bucking some of the general sentiment, and you were correct there. Let's look at where we are now. We heard from Fed Chair Jerome Powell. They have decided to pause for the second time in a row, leaving rates at 5.25% to 5.5%. He did say, though, that he's leaving the door open for further rate hikes if needed, but the markets seem to think that we're done now. We've also got some unemployment data today, which would indicate that the restrictive conditions are starting to take effect, fueling the sentiment that the Fed is done. Given you've been right on the Fed once or twice, what's your call now, Adrian Day? Are we done?
Well, you know, there's a lot in there to discuss. My sense is that Jerome Powell, particularly, some of the other Fed members as well, but let's just say Powell in particular, he would really like to have another rate hike, but he wants it to be at the right time. And he acknowledges the long lags in monetary policy. And as you say, we're beginning to see that play. It's only 1 month, but we're beginning to see a play on employment. In some ways, I think they missed their opportunity last meeting, not this one, but the last meeting. But that's water under the bridge. It's interesting to note that at this week's Fed meeting, 12 of the 19 FOMC members on their updated dot plot, are still calling for another rate hike this year. And, you know, they're not stupid. They know there's less than 2 months left. So they're calling for another rate hike this year, 12 out of 19. So I think it's still possible we get another rate hike, which would send a message to the market, we are really serious about inflation. But at some point, whether we have one more or we don't, I think that's it. The real message now is, as many people say, tighter for longer. How long will they remain tight? Because, of course, the longer they remain, if we keep rates at the same level, the longer they keep those rates at the same level, that is in itself tightening, because the longer we keep it there, the more households and more corporations have to refinance as time goes by. And so it becomes tightening for them. The corporation that refinanced 2 years ago with 3-year maturities at 3%, they haven't, their customers may have been, but their balance sheet hasn't been affected by tightening yet. Not at all. But next year, when those maturities come due, then it hits them. So tighter for longer is a form of tightening. Did I answer the question?
Yes, you did.
Okay, thank you.
But let's go back to this immediate next hike. You say there's a chance, so you're not like 50% chance?
Yeah, this one I'm a little more nebulous about.
Let's say by the end of 23.
I think they will try to do one more. I think the odds are better than 50% that we'll have a rate hike in December. But an awful lot depends on what happens between now and then. If we get another weak employment report, if inflation comes down again, CPI, and that's another topic, of course, but if they get more reason to think that inflation is down and that tightening is working, they may just have no choice but to skip, to pause.
And of course, we also have the geopolitical situation, which adds another element of uncertainty with not only, obviously we had the conflict between Russia and Ukraine when we chatted earlier this year, but now we have tensions really escalating in the Middle East.
Well, of course, and that's why I say with perfect hindsight that they missed their opportunity to hike last month. Last month would have been the time to do it. It's very difficult to hike when you've got a Mideast war and you've got the employment statistics.
But what's interesting, Adrian, is that the markets rallied on this not as great as expected unemployment data, celebrating bad economic data because that means that the Fed is not going to raise, or it reduces the chances that the Fed is going to raise. We had U.S. economy adding 150,000 jobs last month, below the expected 180. September was revised lower to show 297,000 jobs were created instead of 336,000 as previously reported. Revisions of data is another thing we need to look out for. Unemployment rising to 3.9% last time. The point is markets are celebrating bad economic data in terms of equity markets, in terms of Wall Street. So there's a big divide between the fundamentals and Main Street and Wall Street. At what point does bad economic data start to be bad for the markets? Does it start to be reflected in the S&P?
No, excellent point. Well, if I may just back up a second, it wasn't, of course, only the S&P that was celebrating the good news. It was gold as well, celebrating the good news. And markets are always forward-looking, of course, as we all know. So they're looking ahead to the fact that the bad economic news, as you said, means less likely to raise. For the stock market, I think continuing bad economic news becomes bad very, very quickly. Because if you move into a recession, stocks are not the best asset to own if we move into a recession. They're not necessarily the worst, but that's not a good environment for stocks. And particularly if you have a stagflationary environment where you have stubborn inflation as well as a recession or sluggish economy, that's a very bad environment for the stock market. So I think if we have another couple of months, let's say, I'm not a big advocate, or I don't put a lot of strength in these seasonal patterns, but, a lot of people will remind us that there's generally a very strong stock market rally at the end of the year, particularly in the third year of a presidential...
Santa rally, as we like to call it, yeah.
Yeah, and a Santa rally, and then particularly in the third year of a presidential cycle. So, based on history, based on precedent, we should have an ongoing rally between now and the end of the year. But of course, everybody and their uncle is talking about the Santa Claus rally that's coming, which means we may not get it. I tend not to play those rallies because, they're just too short term. And if everyone believes it, you're not really buying bargains, right? So I think we may get another couple of months of stock market strength. But if we have 2 or 3 months of weak economic data, then I think the stock market starts to falter.
Falter how? How dramatically? And I bring that up because earlier this year, I give credit where credit is due. You were right on the Fed, but you and many others were expecting to see a big stock market correction this year.
Did I give a date?
You were, like many others, expecting to see a 10 to 20% decline in the S&P. Now, to be fair, there was a serious dip in March as the banking crisis started to unravel, which was artificially plugged by unprecedented action by the FDIC, granted, so sort of kicked that can down the road, and created an artificial set of circumstances that would have otherwise dragged the markets down. But yeah, the consensus was that the markets would take a serious hit this year. That hasn't happened. On the contrary, I think S&P 500 is up, 15% year to date, and we'll just go by S&P. What does that mean then when you say the market starts to falter then come 2024?
That, Michelle, is why I use the word falter rather than crash or decline. It's a kind of nice nebulous word. You know, I think if the economy starts to slow, but by the middle of next year, and inflation remains stubborn, and we can talk about inflation, but I think the inflation numbers, the CPI numbers, are going to begin to move back up. But if inflation remains stubborn and the economy slows, then that's going to mean earnings are going to slow. So I think by the middle of next year, we should be in a setup for a 10 to 20% decline in the market.
Okay, so let's talk about your big macro forecast. So middle of next year, you start to see 10 to 20% down from where the S&P is now, from when the S&P will be at that point?
From where it will be at that point.
All right, so let's talk about your macro outlook, because you say you expect a recession.
Yes.
And higher inflation.
Yes.
So stagflation.
Yeah. Well, the recession is inevitable in my view. It's all but inevitable. It's built in. And a lot of people think, well, you know, the Fed's done all this dramatic hiking and we haven't had a recession yet, therefore we've escaped it, soft landing, well done Fed. I think they're living in fantasy land. We all know about these long lags. Jerome Powell talks about the long lags, but people forget. You just need to look at history and look at every rate hiking cycle going back into the 1960s. Mm-hmm. And if you look at the date when the Fed started hiking to the date when the recession started, the average length is 22 months. 22 months. We're not even at 22 months yet. So judging just by the average, we should not be in a recession yet, right? So that doesn't mean a recession's, sorry to interrupt, that doesn't mean a recession's not coming. I think the recession is coming. It's a freight train heading towards us. It just hasn't hit us yet. Right. It's inevitable.
Because of the lagging effects of the tightening. But to be clear, when you say recession, you mean the technical definition of recession of 2 quarters of negative GDP growth, even though the Biden administration has tried to massage that definition.
Well, I guess we have to use that definition, don't we?
And so I point out that according to the latest data, third quarter GDP coming in at 4.9%, beating expectations of 4.7%. So that would be quite dramatic to then have 2 quarters of negative GDP growth kicking in
next year.
Yeah.
Yeah. Well, last quarter had a lot of government input, so a lot of that GDP growth was government. I will eat my hat on camera if next quarter's GDP is the same as last quarter's. That's a fairly easy prediction, but I'll eat my hat.
When you mean the same, you mean exactly 4.9%?
No, the same or more.
So you expect it to be lower?
Yeah, well, now I'm not eating my hat. I expect it to be dramatically lower.
But not negative for sure?
Probably not this quarter, no. Probably not this quarter. Next quarter could be negative, but 2 or 3 quarters from now it'll be negative. See, the thing about, so I said 22 months is the average lag of the last 9 rate hike cycles. So you just look at history and you say 22 months. We started in April, 22 months would be, correct me if I'm wrong, but that sounds like February of next year to me. Yeah. This time could be one of the longer lags, and the reason for that is twofold. One is, we all know what's important is not nominal interest rates, but real interest rates. And real interest rates only turned positive in the US in June, July, I forget which, in June or July. So we've only had real interest rates, positive real interest rates, for a few months. So that just delays the recession. The second thing that delays the recession, of course, is that we had excessively easy money with ultra-low interest rates for a long period of time. And what that meant was, during that long period of time from 2008, households as well as corporations, everyone had the opportunity to refinance their debt. Households did it with mortgages, but also corporations did it by terming their debt and refinancing, terming it out and refinancing at lower levels. Everybody in the United States did it, except the U.S. government, which to me is, I agree with Stan Druckenmiller, that's a crime.
Yeah, he's called out Yellen quite aggressively.
And I'll go further. I think the Treasury secretaries Treasury secretaries, because it's not just Yellen, in charge of the Treasury issuance, they should be tried for criminal negligence. When Argentina can issue 50-year bonds, when Austria can issue 100-year bonds, why can't the United States issue 100-year bonds? Anyway, the point is they didn't, and the point is...
Stanley Druckenmiller not mincing his words with his critique of Treasury Secretary.
He was not. But he was spot on. But I made a tangent there, I'm sorry, but the point is people refinanced. And so we have, I think, a longer runway before we hit recession. Think of corporate debt. So corporate debt this year, someone's going to put it in the chat that my numbers are wrong because I didn't look at them before I came on, but corporate debt maturing this year is around, well, let's just do it in percentage terms. You have corporate debt that's maturing this year. It's one of the lowest maturity rollovers for the next 10 years. Next year it's up 50%, and then 2025 is up about another 50% from that. So the longer we're tighter, the more companies get caught up. But for this year, the year that's passed, it was pretty mild in terms of corporate debt maturities. And so that's why the lag's going to be longer.
Got it. And again, the reason I brought up how are we estimating or how are we measuring a recession if it's by the GDP tradition is because, as you quite rightly pointed out, so much of this GDP growth has been, I guess, artificial by this fiscal policy, right? That's moving in contradiction to monetary policy, which is all fueled by excessive government spending. But when you look at the reality for American consumers, you have that disconnect. Inflation doesn't feel like it's coming down or cooling. I mean, it's still 3.7, I believe, year over year, which is the government number. Yeah, which is the government number, but that's still growth of inflation.
Course.
It's not, people
We're not
forget
going backwards.
We're certainly not going backwards. So prices are higher. If you look at U.S. consumer debt, for example, 62% of adults in the U.S. living paycheck to paycheck as of September. That's according to a Lending Club report. So we're not really...
Including the House Speaker.
Including the House Speaker.
Yes, but anyway, sorry, I interrupt. So we're not really feeling that we have a 4.9% GDP. Oh, this is not as Peter Bookvar said, I'll quote Peter Bookvar, the wonderful, this is not a 4.9 GDP economy.
I agree with him. I'm quoting him and I didn't even realize that's his line.
You did.
Okay.
It simply isn't. Maybe another way of measuring whether we're in a recession or not would be for Gallup to simply ask people, do you think we're in a recession? Yeah. But anyway, So the government can avoid a recession by printing money and distributing money into the economy, but then that just makes our inflation worse.
Right. So let's talk a little bit about inflation, because you were saying that you don't think that the Fed will be able to contain it. Hence, you said stagflation, that we'll still have higher inflation.
Well, I don't think they'll be able to. I don't think they will have quashed inflation back to their arbitrary 2% level, which is nonsense to begin with, but back to their 2% target before we have a recession, right? So if they if they get inflation back to 2%, they will be making the recession that much worse. So what I'm saying is they will not get inflation to 2% before we have a recession. I think the CPI numbers are going to begin to move back up a little bit for the next 3-4 months for a couple of reasons. One reason is the base effect that we all know about. But if you look at the inflation numbers from last year, from December, January, February, March last year, right, now they were lower. So now we'll start seeing the numbers go back up for this year. That's number one. Number two, oil. The price of oil works its way through with a lag, works its way through into the cost of every good in the store. Everything we buy has to be transported, even if it's only 50 miles. All has to be transported, and if the price of oil goes up, that makes the price of goods in the store go up, but with a lag. So we see it first, it hits gasoline, and of course, and it hits airlines, but it hits everything with a lag of 2 to 3 months. You look at what the price of oil has done since June, July. We're beginning to see that effect move into the price of goods in the stores.
And Adrian, that's all assuming that the geopolitical situation in the Middle East doesn't get any worse.
Sure.
And that doesn't bring in other players. That's assuming that the conflict remains contained to between Israel and Hamas, and we don't get other players involved, because the World Bank, for one, is warning that we could see oil at $150 a barrel if other players get involved, if Iran, which has been supporting its terrorist proxies, Hamas and Hezbollah, but if they get involved more directly, if Iran...
Blockade the Straits of Hormuz.
Exactly, what 20% of the world's oil supply goes through. So that's, again, under the scenario that things just stay as they are.
Right.
What happens? Do you have a base case for an escalation?
Well, I'm not a geopolitical theorist, and we all have opinions, but I think it's dangerous to talk as an expert about things you don't know. I mean, it's obviously a risk, right? It's obviously an enormous risk. Very clear, it seems to me, that Israel this time around is not going to call a halt because, the United Nations and ex-presidents Blair and Obama tell him he should be a little more. They're not going to call a halt too soon. They're going to carry on, and in my view, rightly so, but that's a different issue, notwithstanding the horrific, I won't use the word collateral damage because I just hate that phrase, but notwithstanding the horrific damage that's being done to innocent people on both sides, but they're going to carry on until they have achieved victory, which is, wiping out the terrorist organizations. How long that takes, I don't know, but does it mean that, so we run the risk in that time that something happens, and it could happen by accident, or it could happen by design.
Right.
But you've got U.S. warships in the Mediterranean, and
yeah, there's a lot of potential things
Absolutely.
that could go very wrong very quickly and throw out
And
even
just
the
escalate.
scenario, and escalate things
But
dramatically.
of course, if something does happen and oil jumps to 150, that only
exacerbates.
Thank you for that nice word. Exacerbates both inflation and recession.
Right. So it brings us to gold, right?
Yes.
Because earlier this year when we spoke, we were, many of the people at the conference that we were chatting at, including yourself, were expecting gold to reach a new all-time high in 2023. And at the time, we had the same number of factors. We had inflation.
Right.
We had the potential of a recession. We had the geopolitical tensions with Russia and Ukraine. We had record purchases from central banks. Now we have, according to the World Gold Council, continued robust purchases from central banks around the world. In fact, 2023 is looking to perhaps even surpass 2022 in terms of the most gold bought on record. We've got an added geopolitical risk, as we've mentioned, that could impact oil and other factors. We have inflation. We have the Fed. We have a U.S. National debt at $33.5 trillion. We have major concerns about the U.S.'s ability to even service the interest on this debt. And gold hasn't made a new all-time high yet, unless you count the move we saw in the COMEX futures to 2018.
Yeah, we saw a blip.
We saw a blip. Okay, if you count that in March.
We did get there.
Okay,
yeah.
All right. If technically you and Lobo Tigre are correct then. Yeah. We did have, according to the COMEX futures, gold hitting 2018 briefly during the banking crisis in March, but not a real all-time high.
Okay. Well, I think a couple of things there. First of all, there is a misunderstanding, and I'm not going to talk about me now. There's a misunderstanding about the effect of geopolitical events on gold. So when Russia invaded Ukraine and we had inflation numbers moving up, a lot of people, I wasn't one of them for those reasons, but a lot of people were saying, gold is off to the races. Now, there's misunderstandings about the effect of geopolitics and, in fact, the effect of rising inflation on gold. First of all, with geopolitics, you look back to the 1960s, geopolitical events of all stripes tend to have very short-lived impact on gold. That was true of 9/11. That was true of, but lots of events, the Turkish near coup, and so on and so forth. They tend to be very, very short-term events. And we saw that very clearly with the Russian-Ukraine invasion. Gold spiked, and within 3 months, gold was back to lower than where it was when it started. With regard to inflation, is what you were talking about a little bit earlier, market looking forward. When you start to see inflation pick up, the gold market says, that means the Fed's going to tighten, which is bad for gold. And so rising inflation, that, of course, there is a correlation between inflation and gold, but it's not a contemporaneous correlation. And so you can see that very clearly over the last 2 years. Every time the market thinks the Fed's going to pause, gold goes up, almost regardless of whether the inflation numbers are up or down. The inflation numbers move up, and the market says, the Fed's going to hike more, and gold goes down. So there is a correlation, but it's not a contemporaneous inflation. So anyway, that's why gold didn't move as much as some people wanted it or expected it to last year. But I will say, 2023. Well, last year with Ukraine,
okay,
and this year. But I will say two things. First of all, yes, this year and last year. I will say two things. First of all, a year ago, gold was just over 1,600. It's now whatever number you pick, because it changes so frequently, but it's now approaching 2,000. That is a pretty darn good rally for 1 year for an asset that's meant to be a defensive insurance asset. So gold has moved, in fact. The second thing I will say is that gold bugs, and I'm not being condescending because I'm a proud gold bug, I'm a proud member of a club, but we always expect too much. We always expect too much too soon.
Why is there just a short-term move on geopolitical tensions if gold is seen as a safe haven? Why is it just a blip usually? Because none of the dangers have really evaporated. Russia, last I checked, is still, a nuclear power, for example.
You asked me why.
Yeah, why is it just a short-term?
I'm a historian, not a psychologist.
Okay, well,
so
from a gold
Jordan
market's
Peterson
perspective.
So I'm a historian. I simply look at the facts. What tends to happen is two things. What tends to happen is, first of all, if gold is already in a bull market, then geopolitical events are just adding fuel to the fire, and they have much, much more impactful, a greater impact. So we saw that with the Iran hostage situation at the end of the 1970s, when gold was already in big move. I think also if there's a lot depends on the fear and concern as to whether the geopolitical event, whatever it is, will be contained or will spread. Mm-hmm. And if the market thinks it's contained, then gold retreats. But again, I'm not a psychologist. I can't answer your question. I'll have to think about it. Yeah. I've just looked at the history.
All right. So curious that there is just a short-term reaction, right, and then a pullback, perhaps, a panic purchase, and then reassuring ourselves that things are going to get better, right?
Yeah. All the people that are concerned have gone out and bought the gold, and, there's no more people that are concerned.
Right. Well, we could say that there is plenty to be concerned about. We know that Jamie Dimon is saying that we're in the most dangerous times in history, in his living history. So clearly a lot of things that are raising alarm bells.
And gold has held up longer this time than it did with Ukraine, I think because of the greater concern that this conflict will continue and spread.
And of course, as myself and speaking for most of the guests, if not all of the guests that I've had on the show, we would much rather have gold not move than have any of these geopolitical developments escalate.
Well, and that's what I said in my talk yesterday. I mean, I'm glad that gold doesn't move up on geopolitical events, because it'll move up for other reasons. And frankly, it's moved in the last, whatever it is, time flies, doesn't it? Not even when you're having fun, it still flies. But gold moved up not just because of Hamas terrorist incident, but at the same time, we had that turmoil in the bond market, long-term bond market, right, yes, with those, I won't say failed auctions, but very, very weak auctions. where there were very, very long tails, and it was on the 3, the 10, and the 30, and then this week the 5 and the 5 and the 2. 2 was okay, but the 5 was bad. So we had a series of bad auctions,
Right.
meaning the interest rate had to move up to clear the bonds. The dealers were left with more bonds on their books than they usually are, and the tails were much, much longer. So we had that, and that sort of turmoil in the long-term bond market is also what propelled gold, to be honest.
Right.
It wasn't just the Hamas.
We're seeing a slight pullback on 10-year and 30-year yields because of sentiment that the Fed is potentially done. But still, bond markets are signaling distress. And as we touched on, you still have to service, all of that debt at these higher interest rates.
Yeah, well, I will say one thing. I mean, this is just, I will willingly buy a 3-month treasury for 5% interest. There's no way I'm going to buy a 30-year US government bond for 5%. I mean, just not going to do it. It just does not look an attractive risk reward to me.
Right.
And I'm sure I'm not alone in that. So what I'm saying is I think long-term rates will move back up.
So, Adrian, what is the best way to protect one's portfolio and to position oneself in this environment? Yeah,
well, first of all, you never put 100% into anything, obviously. I think one's justified in having a significant amount of one's money, whatever that means, just held in cash in short-term treasuries. When you can get 5% just waiting for opportunities to clear, to opportunities to become apparent, for risks to clear, just waiting. I think, and we're in that situation right now, I think. So a significant amount, depending on the individual, in short-term treasuries, I think is a great idea. Outside of that, you never put everything into all your eggs into one basket, but I do think the gold stocks are becoming, they've always been, all year, I said that last time, very, very undervalued. But a thing can be undervalued for a long period of time, right? But I think we're beginning to get to the point where that undervaluation is going to start attracting buyers. So the gold stocks are very undervalued. We don't have to go into that. It's the same story that it was 6 months ago. Someone like Agnico Eagle is selling at pretty much the lowest price to cash flow that it has in 40 years, which is nonsense when this company's so strong, the market's so strong, the outlook for gold is strong. So gold stocks are very undervalued. But I think we're approaching a time when we're going to start seeing the gold stocks attract buyers. If the stock market starts to falter, not crash, but falter, we're going to see a rotation. We're going to see a rotation out of because if it crashes, everything goes down. Yeah. So I'm not trying to be funny now.
No.
If it crashes, everything will move down. But if it starts to falter, then we'll start to see the tech leaders, not just the Magnificent Seven or whatever they're called, but the broader, the top 100 or 150 or 200 in the S&P. We'll start to see people move out of those and rotate into sectors that look undervalued. That will be traditional value stocks. That will be consumer staples. But it will also mean oil stocks, which are still undervalued. It will also mean gold stocks, in my view.
All right, let's touch a little bit on gold stocks, though, because it has been very frustrating for many gold investors to see gold hold its own, up 9% year to date, more or less. The VanEck Gold Miners ETF, GDX, down 1.4% year to date. It actually popped up a little bit today, but has been dragging the whole year. The Junior Miners ETF, the VanEck one, GDXJ, down 5.5%. Newmont, down 17.8%. Barrick Gold, down almost 5%. Yeah. The juniors, the big players, why? Yeah. Why is this?
Well, let's cut Newmont out because I'm not a fan of Newmont. I think there's good reasons why that's down, but that's a different story. Let's look at what are the reasons people are buying gold. If you're buying gold and partly, largely, but partly, certainly, one of the reasons people have been moving into gold is for geopolitical concerns, for the safe haven. Well, if you're looking for a safe haven because Israel and Hamas are in a war, you buy physical bullion. you don't buy Ego, and you certainly don't buy Consolidated Ajax Exploration, to pick a name out of a hat, right? It's so the reason the gold stocks have underperformed gold is entirely dependent upon, or not entirely, but primarily dependent upon whatever reasons people are turning to gold for in the first place. Now, when the stock market starts to fall and people start turning to gold as an alternative to the stock market, then the gold stocks will perform.
What about when people are turning to gold because of fiat debasement and devaluation and a 33.5 trillion national debt and concern about the dollar? Then a speculative bet there would be gold miners as well, and even the junior explorers.
No, absolutely, and I think we're getting to that point now. But I think if you ask people who've bought gold in the last 6 weeks, why did you buy gold? I would guarantee that Israel, Hamas is the leading reason, and the federal deficit is a long way.
And that's
down
gold in terms of gold coins and gold bars is what you'd expect. And our last time we chatted, I believe you said to have at least 5% in gold bars and gold coins as physical insurance. That you just put it and you don't think about it, and that's just physical insurance. How has your portfolio allocation changed, if it has?
Well, I think that 5% is partly an arbitrary number. It really depends on a person's comfort level. Some people would like more, some people are happy, and particularly if they're older and wealthier, with liquid assets, you don't need so much physical insurance. It's insurance, so it's a matter of what's the comfort for any particular individual. But that's not a number that's going to change. If I pick my number of 5%, it's not going to change year to year. That's an insurance, just like I don't buy more insurance, just because we had a hurricane last year. If I have enough insurance, I have enough insurance. But in terms of, apart from the insurance, looking at the investment portfolio, we're still very high. I was premature in being as high as I was on the gold stocks, but still very high, and the reason about 30%, frankly. And the reason is because, first of all, we're increasing our cash. So then, in a barbell approach, if you're having more cash, you can afford more speculative assets at the other end. But also, there's not a lot else that really looks attractive right now. In this kind of environment, I would normally say, well, the smaller markets, the emerging market stocks, they will be attractive. But they typically are, in a stagflationary period, they typically do well, but they typically only do well when the dollar is weak. And with the strength of the dollar, I'd be hesitant about putting too much into emerging markets right now. So when you look around the world, I don't want to be buying Apple. I don't want to be buying NVIDIA. Certainly don't want to be buying NVIDIA. What else is there to buy? And so that's why we have gold and other resource stocks.
Right, gold and other resource stocks, and T-bill and chill.
Yeah.
For as you said, park your cash, get 5% for now, and have the dry powder ready to go.
Exactly.
Final thoughts, Adrian. We chatted earlier. This conference has been around since 1974.
Yes.
It's one of the preeminent investor conferences in the world, longest running, one of the longest running. You said your first time here was in 1981, I believe?
It was either 80 or 81. I can't really remember.
Okay, so you've had a good long run at the New Orleans Investment Conference. What is your takeaway from this year's conference? Is there anything that has stood out to you?
I think one of the things that stood out a little bit this year, which is good to see, is that we have a lot of very, very bright, original thinkers. And even though most of us are coming from the same fundamental philosophy, we like hard money, we don't particularly like government, we certainly don't like excessive government, but it's nice to see that people can come to different conclusions, and because that's life, right? When everybody's saying the same thing, there's probably something wrong with the logic. So, someone like Brett Johnson, for example, incredibly smart person with his dollar milkshake theory, which I don't like that name, but anyway.
We had on the show, yes.
Yes, but very smart guy, right? Very smart. He thinks through what he's thinking, and he comes to a conclusion that a lot of us who haven't thought as deeply about it as he has, perhaps we just come to the opposite conclusion. So it's really great to see very, very smart people like him who thought about it, have the same basic philosophy as the rest of us here do, come to a different conclusion, and it challenges your thinking. And I'll just, an added thought on that, if I may, and it comes back to, the expectations that gold investors have, and comes back to something else we said at the beginning. People are always confusing what they want with what they think will happen. And
confirmation bias, I believe it's called. Yeah, validating their own viewpoints.
Yeah, and this is true in life in general. Yeah. But it's so important to recognize you can want something. You can hate government spending a lot of money. You can think the dollar should be lower because it's just not right that the Fed is printing so much money and the government's throwing it around on welfare and the dollar's so strong. It shouldn't be strong. But you've got to look at it logically and take what you want away from the equation and just look at what you think will happen.
Right. Just because you want it to be doesn't make it so.
Unfortunately.
So a diversity of perspectives and opinions at this year's conference, even though most people are coming at it from the same fundamental ideologies and values. And that's what we like to offer in Kitco News, a diversity of perspectives and approaches and a wide array of opinions for our viewers to make more educated and informed decisions. So thank you for giving us your perspective, Adrian. Always lovely chatting with you.
Well, thank you very much for having me.
All right,
really appreciate
Adrian
it.
Day, thank you so much.
Kitco News special coverage of the New Orleans Investment Conference is brought to you by Discovery Group.